Thank you so much for that kind introduction. I have to send you the check in the mail. You said so many positive things that was unexpected. But happy to be here with you guys today. This, as Chris said, this is not my first time. And so it's always good to engage with you guys and engage with this program. I'm trying to pull up my chat so I can see you guys at the same time. I'm hoping that this is going to be an engaging session. As she said, I work for Synchrony Financial. I'm actually approaching my 15th year here, where if you think about when I started, I definitely didn't think I was going to be here for 15 years. And I'm sure that's probably not an expectation that you guys have when you guys are coming out of school now. But 15 years, it's been great here. We were just ranked the #2 best company to work for. So we're really proud of that work, and that's probably why I've been here so long. So as we go through this presentation, right, the goal of it is really to be engaging. So if you guys have questions along the way, please don't hesitate to ask and engage. Definitely we want to make sure that you're getting the most out of this as you can. And obviously, like as you get to the end of it, like we want to make sure that you guys get paid for engaging as well. So looking forward to that aspect. So as we think about this session, again, my goal and my hope is that we are very interactive in this session. I'd love to hear from you guys on what are some of your goals that you guys have. And so it can be personal goals, it can be school goals, it could be physical goals. Like I just love to hear what are some of the goals that you guys have.
I am McCall Johnson, a junior computer science major with a minor in math from Winston-Salem State University. And my end goal is to honestly get enough certificates in information technology so that I can become a network analysis and data engineer.
See, I knew when I asked this question, this is the first time I've taken this approach in these sessions, but I felt like when I asked this question, I knew I was going to get some really good responses because one, you guys are in this program, which really makes me think that you guys have thought about the effort, the energy that it takes to apply for these scholarships. And mostly what I find from a program that's as rigorous as this is that people have plans, right? Like you guys have solid plans and a vision, which is what I had going into school. It's funny, like I did go to school for electrical engineering, but coming out of school, I was like, I don't want to be an engineer, right? I didn't want to work for, I didn't want to work for a big company. I didn't want to work for like the GMs of the world. I didn't want to work doing processing. I wanted to get into something that was more business related. So I had a plan, right? And so it's interesting listening to Cash and McCall as they talk through their plans. You can see it had a vision that they had already laid out, right? So I'm also curious about, do you guys have some financial goals? So have you guys thought about like what your financial goals are for the future? I'd love to just get a couple people to chime in on those as well.
Personally, I want to open a high yield savings account soon. So.
Okay. What else?
I can go next. Oh, go ahead, Maxwell. Your hand was up.
My name is Maxwell Rodney. I'm a master's student in supply chain management at Ohio State University, the Ohio State University. And my financial goals is to I don't know if anyone's ever heard of FIRE, retire early. So that's my financial goal, hopefully with IRAs and everything.
What's early?
I would say for me, like 40, 45.
Okay. So we'll end it with Kimberly and Ravina. So Kimberly, I'll let you go next.
Hi, everyone. I'm Kimberly Maitland. My current financial goal is saving up for a car. Yeah.
Nice. And then Ravina?
Hi, my name is Rubina. I'd love to come off camera, but I'm in the office today.
No pressure.
I cannot. Something I would like to work up towards is starting investing in a brokerage account. So with ETFs or index funds.
Yep. Love it. As you guys think about this conversation, part of the work that goes into financial success really just comes down to planning. Right. And that's, if you take nothing away from this, right, that's one of the key things I want you to take away. That planning and having a plan of action is the target of how you help to reach your financial goals. And so if you think about this mindset, right, historically, right, we've been in this space where if you guys think about like probably your grandparents and your grandparents' parents, maybe even some of your parents, but definitely your grandparents, right? There was this space and time where, as you guys think about the American dream, and I know that term, the American dream, is subjective. If you think about that American dream, right, there was this view that if you lived in this country You got a good paying job, right? Maybe you worked at the factory. I'm from Detroit. So maybe you got a job working at the car manufacturer, or a Ford, a GM working at the factory. You worked that job for 30 years. You bought a house, right? That house came along with a 30-year mortgage. So you've worked this job, you've started your family, you bought this house, everything kind of goes for this 30-year time period. And once you finish working, right, you would, what up the hoe? You would be able to take your pension that you got from that job. You would, that money that job was going to pay you was kind of like a contract. You work for 30 years for us, we're going to pay you out this pension that you can take forward the rest of your life. And then you had Social Security, right? That's that agreement that you have with the government. That Social Security is going to be there along with your pension, and that's how you're going to survive kind of the rest of your life, right? That's actually the exact plan that my mom used, right? My mom worked for AT&T for almost 40 years, and she ran the numbers as she was approaching retirement, and she said, hey, I have enough. Based on how I've lived my life, based on the plan that I put forward, I can survive paying off the rest of my expenses going forward with my pension and my 401k. That's the vision, right? That's how things got done, right? But now things are a little bit different. As you think about now, you have people like Maxwell. Maxwell's like, yo, I'm not trying to work for anybody for 40 years, right? I'm trying to work for 20 years and be done, right? This responsibility has now become on the employee, or you guys as workers in the corporate workforce, to take control of that financial future, to own that financial future as you go forward. People are marrying later, they're having fewer children, the cost of homes are exponentially higher, and pensions are less likely. As you guys think about pensions, those are primarily going to be through government jobs, and I'm sure you guys have been following the news. Government jobs are less likely than they were 3 months ago. And they're going to come through like city jobs or something like that. But most of the responsibility comes on you guys to start to save and invest for your financial future. And when we talk about retirement, let's ask this question: what age do you guys think retirement is? I see a couple hands up, so let's get the hands, and then I'll ask the question. So, Soraya.
Yes, it's Soraya, and I apologize I cannot come off camera right now.
Okay.
But it looks like the age of retirement is 65 according to societal standards. 60, 65 area. I've also heard 67.
Okay. I see a bunch of people in the chat. They're saying, hey, 65 to 70, right? That's what I've heard, or 75, even 75 is real late. If I had to work to 75, like, I don't know if I'd make it. This control has shifted, right? And I would like to put in the notion that retirement is whatever age you're ready for retirement, right? Because again, this responsibility of saving and investing and planning for your future is now on you. And so if you say, hey, I want to retire by 28, it's possible. I don't see why it shouldn't be possible. If I want to retire by 40, why shouldn't that be possible? Or if I want to retire by 50 or 35, right? Whatever that number is, why shouldn't it be possible? It is possible. And that's what I would like to contend for you guys today. And hopefully, as we go through this presentation, you'll see how you can accomplish that. And so I see a question, the pension. So a pension is essentially just an agreement that you historically have had with the company. So if you think about like military jobs today, right, or government jobs today, they will all have some type of pension payment. Or if you think about like your school district, like teachers, they all have some type of pension agreement. So pension essentially says, hey, you're going to be working overtime for this company, and as you're working overtime for the company, they're putting away money on your behalf that you can access when you leave that company, which is typically going to be after some extended period of time, like 30 years, right? So if you're like, for example, if you're working in the military, people say it's 20 years in the military and then you can retire, right? They put together some type of pension payment for you, right? So it's just like, think of it like Social Security. It's just a payout that goes on for the rest of your life, but it's paid by the company. And sometimes you can put into it as well if you like to. So sometimes they have variables where you can do it, you can put in money, but typically it's going to be primarily the vision that I'm talking about is the company putting in money on your behalf. As we think about the view of, hey, it's in your hands, it's your responsibility, and the timeline that it takes you to get to that point of saying, hey, or to reach any financial goal, right? It's not necessarily just retirement, but to reach that financial goal, if you're saying, hey, I want to stop working by 25, 40, 35, 65, 75, it's what I would lean into is that, one, we should have a long-term approach to how we do that. And how we do that is taking advantage of, I think what Joseph mentioned earlier, is this power of compound interest. So compound interest is very simple. It should be a very simple concept to understand. It basically just, hey, it says, hey, the money that you're making and the money that you save and invest should be making money for you. That as you put money into your investments, those investments will give you a return, right? That you're making money on that investment called a return. And over time, that return starts to build up, right? So if I was getting a return of 10%, and I put in $100 this year, at the end of the year, I would have $110. If I didn't put anything else in there, the end of next year, I have another $10 from my $10, but I have $1 from the $10 that I got the first year. And that money starts to compound over time. So as you think about this example that I've laid out, if you started with zero, you started with nothing today, and you put in $225 a month and you invested it in the stock market. And so when we talk about the average return that I've laid out here, this is the average return of the S&P 500. So if you go to Google, google.com/finance or finance.google.com, and you look on there, they'll have the Dow, the S&P, the NASDAQ, I think they have the Russell, and they have like the VIX up there. All of them should be pretty red except the VIX today, right? Because the market is down. But historically, if you look at the life of the S&P 500, it's returned 10% a year. So if you say, hey, if you put your money in there for $225 a month, at the end of 30 years, you would be on this yellow line, this $81,000 that you put into it. But your money would naturally grow to $444,000. Right? That's compound interest. That's your money working for you over time. And that's really what I would, that as we talk about the responsibility now shifting to you, it's now your responsibility to start to learn, right? Understand how this process works, but then understand as you guys are thinking about your investments, as you guys are thinking about, the retirement, right? Making sure that you're kind of getting to the targets and goals that you wanted to hit. So again, if we go back to the early example and say, hey, I want to retire by 40, right? There's probably a path on here that you can get to 40, right? You can get to whatever that number is. If you say, hey, I need $1 million, I need it in 20 years or so, you could get to that number, right? By increasing how much you invest every month or increasing how much your return is. And we'll go through some of those examples, but that's possible, right? The control is now, again, in your hands to start to think about, solve, and plan for your financial future for the short term and the long term. And so as you think about how you do that, right, and how you get to becoming a millionaire, right? As I said earlier, it's about having a plan or approach to get there. And I think one thing that we'll say is true about every millionaire is in order to be a millionaire, you have to have a net worth of $1 million, right? You have to have kept $1 million, or that $1 million, or whatever money you kept is 81,000 had to have grown to $1 million, but you held on to it, right? That's what makes you a millionaire. You've kept you've kept $1 million. And so when you think about strategies to do that, I would like to contend that it's just about planning. Right? It's about having a plan and approach that's going to get you to that target number that you like to get, that you're trying to work towards. And so the approach that we like to share and that I use in my personal finance, I have, a wife, I have 2 kids, we have a monthly budget meeting. We have a yearly annual review of our meeting. This is the framework that we use. It's called the 50-30-20 framework. It's a very simple framework. It just says, hey, as you guys are thinking about your costs, thinking about the money that you're bringing in from your jobs and your paychecks. And I understand, right, that you guys are in college now. And so some of this you'll say, hey, like, I don't need to pay some of these bills today, right? And so this is a framework. It's just a concept for you guys to think about how you're going to approach things in the future, but these numbers may not necessarily be accurate and relevant to where you are today. But the framework, it really teaches you 2 things. One, it's teaching you how to live below your means, right? That you're taking the money that you're bringing in and you're going to be saving some of that money. Again, to become a millionaire, you need to have $1 million. And the only way to do that, not the only way, one of the primary ways to do that is to keep some of the money that you're making. That's the concept of living below your means. So here you're taking 20% of that money that you're bringing in. You say, hey, I'm going to start to save and invest that money, right? I'm putting it in an emergency fund. And HSA is a high yield savings account, which you'll usually get as you guys start to work. You'll have access to as you guys start to work. It's for medical expenses. You have the 401ks, you have your IRAs, you have investments, you have college savings, which are things that you guys could do now. As you think about the 50% are needs, right? The things you have to have in order to survive, your bills, your housing, your cell phone bill, your utilities, right? And really, it could be anything that you put in the needs, right? If you say, hey, a need for me is to have a massage once a month, that is a need for my mental health and my development, right? I need that, right? That's going to be in your needs category. And the other 30% is wants. Whatever you want to put in that one category, you can put in that one category. But the key thing here is that you're saving that 20% and you're spending again less, you're living below your means. You're spending out, you're putting out less than what you bring in, and you're then taking that 20% and you're starting to invest it and save it for yourself and for the future. So 50-30-20 frame, right? This is a foundational way, and whatever works for you, it doesn't have to be the 50-30-20, right? And you may say, hey, today, I don't have, as I think about the money that you guys may have access to, you guys may have scholarship refund checks, you guys may be working at jobs, but you say, hey, my needs are only 20%. Well, then your savings today could be 50%, it could be 60%, right? And then you can start to put that money to work for you in investments, or you can start to put it in an emergency fund so you have something to fall back on if you needed to, right? So it can change over time. What I will say, don't do what I did. Like I was fortunate, just like you guys. I had scholarships when I was in college. I had more than enough scholarships to pay for the things that I needed, and I bought a ton of shoes. Like I wasn't even buying Jordans because I'm from Detroit. I didn't even have I wasn't buying Jordan shoes. I was just buying different shoes. I was buying Timbs. I was just buying whatever, right? Just because I could, right? I probably could have invested that money more. I wasn't sticking to the 30%. I'll say that, right? So find a framework though, right? Put some money into find a framework that works for you based on where you are. But as you guys get into your careers and start to work, right, I would definitely say you should at least be saving 20% as your go forward approach. So should an emergency fund sit into a conventional savings account? I'll come back to that one as well. I'll come back to that question as well, Katie. So the first step is kind of having a framework, an approach to how you're going to essentially budget and use your money and allocate your money on a month-to-month and a week-to-week and a day-to-day basis. The second part is understanding where your money is going, right? If you have a framework and you say, hey, I want to live by the 50-30-20, but I don't know how much is going to the 20%, I don't know how much is going to the 50%, right? Then you're probably going to be less successful in actually hitting those goals and those targets that you want to approach. And so I would contend that you guys would all have a spending tracker functionality, right? And so a spending tracker is just saying, hey, if I list out all the income that I have coming in, I list out my bills, where I have my money coming out, I list out some things that I want to plan for, right? If I want to take a trip, if I want to put money in the charity, if I know I have some expenses that are non-common, or they may be like once a year, like your registration for your car, or you have gifts that you have for Christmas, right? Things that you have to plan for. But everything should flow through some type of methodology where you can understand and look at and evaluate where your money is going from a month-to-month basis, right? To me, this is important to understand that throughout the year you may have different trends on how your money goes, right? I use a spend tracker that looks exactly like this because I'm more of an Excel person than I am like a Mint.com, or they don't have Mint.com anymore, but like an Empower or some digital. I like to have the flexibility of being able to move this chart around the way I want to. But what it helps me do is it helps me understand from year to year, how my money is trending, from quarter to quarter, how my money is trending, how my expenses are trending, right? I have a 6-month-old daughter. And so later on this year, right, she's going to be going to daycare. I put that in my tracker. How is that then going to flow through the rest of the money that I expect for the rest of the year, right? Those are the things that you can start to evaluate. But the key point is you want to have a way to understand where your money's going. So a spend tracker is a really amazing way to do that. And it should be part of the routine. One of the things that you guys need to start to learn and understand is, I miss Mint.com too, is that you guys should have a relationship with your money, right? You should be building this consistent conversation that you say, hey, I understand what I have coming in. I understand where things are going. I can make adjustments on things that aren't working for me. And I can ensure, right, that I'm meeting those long-term goals that I have, right? Hitting that 20%, or it could be more. You may say, hey, I want to be at 30%. I want to be at 40%, right? You should have a way to kind of understand that. Joseph, I'm going to come to you in 1 second. You should have a way to kind of understand where that money is going. So I like to use an Excel sheet, but there are other like digital platforms. I see someone says YNAB on here. There's Good Budget. Some of these are free. I'm not necessarily recommending any one of these as ones that you guys should use. I'm just saying that these tools are available to you and options for you that you can use from a digital standpoint. You can use an Excel tracker, or you can use kind of an old school, like an envelope method, right? You're taking out cash, you're putting that cash in the envelopes, and once that envelope money is gone, that money's gone for the week or it's gone for the month, right? Really doesn't matter what approach you have, right? But you should have an approach. You should have a way to understand where your money is going from a month to month, a year to year basis, right? And that's really going to help you develop trends and keep you consistent on meeting kind of, again, those financial goals. Joseph?
Yeah. Will you link that Excel tracker that you just exemplified?
Yeah, I will send you guys an Excel tracker that I've used in these sessions before. So you guys will all
Thank
have
you.
a copy that you guys can kind of dig into and play around with.
Terrific. Thank
Yeah. All right. So now we're going to go into kind of the next phase, right? So again, the approach that we're talking about today is a long-term investment approach, right? This is not the only way for you to get to long-term financial success, right? I'm primarily talking about investing, right? And investing for the long term, right? As you guys saw from that chart before, right? That compound interest, you're investing in something, you can consistently invest at 225 a month, you're doing it over 30 years, and that money starts to grow for you over time, right? It's a long-term approach, right? There are other ways that you can build, financial security, right? You can be in a real estate, you can start a business, you can buy a business. There are other avenues, right? This is just one perspective. And it's not, but my point is, it's not the only way that you can do it, right? So you have to, again, explore the things that work for you. But this is going to be, again, more and more common, some of the things that you guys will be asked to do because you're going to be engaging in 401ks, you're going to be engaging in IRAs, right? This aspect of control that has now come to you that was less prevalent before, this will be probably more than likely be a natural part of the lifestyle that you have to lead, because you have to have those tools, because you'll have access to those tools through your jobs, through your employees, etc. And so when you think about investment and investing for the long term, there's really three kind of key interest rates. There are three kind of key factors. There's the investment amount, right? How much you're putting into that investment over time. There's the rate of return, right? How well that investment is performing, right? So as you guys talked before, that S&P 500 has historically returned 10% over the lifetime of the S&P 500. And then the time frame, right? As Joseph mentioned earlier, right? The earlier you start, the better, right? The earlier I can start on the curve of investing and planning for the future, that exponential compound interest curve gets me and starts to grow sooner, right? I can start to ramp up on that curve sooner rather than later. And so as you think about that approach and these three factors are really going to be prevalent in the investment options that you guys have available to you. And again, this is not a comprehensive list, but these are some of the key things that you guys will probably engage with and interact with, right? So you have these short-term investments. So you think about the short-term investments, you think about checking accounts, savings accounts, places where you put your money in for a typically short time. Maybe it's like, checking and savings are going to be, you need to access that money on a regular basis, monthly, weekly, etc. You have high yield savings accounts, certificates of deposits, money market accounts, right? Those are typically places where you may say, hey, it's 1 to 3 years or something like that, but it's going to be a shorter amount of time that you need to access that. And because you have that shorter amount of time, those typical investments pay out at a lower return. So as Joseph mentioned earlier, right? And that return can sometimes fluctuate. As you guys think about where we are now in the economy, we're in a high interest rate economy, right? High yield savings account may be paying out 4%. But if you go back 6 or 7 years ago when we were in a low interest rate economy, your high yield savings account may be paying out 50 basis points or 0.5%. And so that can fluctuate over time. And so as you guys are thinking about your goals, right, you have to, that again, I think one of the other key topics here is that your money is your responsibility. No one's going to, monitor your money for you, right? No one's going to make sure that you're meeting your financial goals for you. I guess you can hire like a financial advisor, but even so, you got to check them too. So it's still going to be your responsibility at the end of the day, right? So as your money fluctuates, as these markets are changing, as the interest rates are changing, you have to be making assessments over time to say, hey, am I getting the return that I need to, or am I comfortable with the return that I'm getting that's going to help me get to that long-term goal, whatever that long-term goal is. And for each person, that long-term goal is going to be different. And so let me get back to Katie's question. So should an emergency fund sit in a conventional savings account or high yield savings account or something else? Again, all these questions that are similar to these are going to be, it depends, right? I would say if I was thinking about where I started out, and if I was originally getting into investing, I would put my money into, like today, right? I would put my money into like a high yield savings account, right? Because I know it's paying out 3 to 4%, and my savings account may only be paying out 0.25%. So I would make more money putting money into a high yield savings account today, right? But if I was looking at, if I was a more seasoned investor, there are other options that could become available to me where I could put it in and get more of a consistent, or a higher rate of return that I can still pull the money out later, right? So it just depends on where you are in your situation. But I would say, you want to put money that is for your emergency fund in something that you feel is safe, and something that you know that you can access quickly if you needed it to, right? That's the whole goal of the emergency fund, right? That if something came up and I needed the money, I could pull it out quickly. And you would want it to be there, and you wouldn't want it to be in a high risk asset in the time that you needed to access it. So you guys think about these midterm investments. So midterm investments, right, would be anything that are kind of longer than short term, and they have a range of risk associated with it, right? And even within the particular segments that I've listed here, right, there's a range of risks, right? So as you think about stocks, you can buy a stock, an individual stock, and that stock is going to be more risky than, let's say, the S&P 500, for example. The S&P 500 is 500 companies, really in one stock or one ETF. And Apple is Apple, right? So if Apple does bad one day, but the total of these 500 companies do well, right? The S&P is going to go up and Apple is going to go down, right? So there's differentiation in risk, but ideally, these stocks, mutual funds, ETFs, they're going to pay you out a higher return. You're leaving that money in there and putting it in a more risky asset. That risk will be paid off with a higher return. Bonds are actually like loans. They have a lower risk. And they have some other nuances. But what I would probably say about bonds is the bonds are becoming less and less likely to be part of your long-term strategy. It used to be a view that if you had a 60% stock portfolio and a 40% bond portfolio, you would kind of be set for the future. Bonds have been returning kind of negative rates over the last few years, right? And so that dynamic may be changing. As you think about cryptocurrency, I know that within what I would probably say is this generation and your population, that cryptocurrency is a vast topic. If you think about stocks, bonds, and mutual funds as something that you guys think of vast, cryptocurrency is another vast, wide-ranging topic with a lot of dynamics. What I would say with anything that you invest in is that you want to make sure that you understand where that money is going and you want to understand what you're investing in. And so if you get into a space where you don't understand it, right, I would probably not encourage you to do it, right? I would encourage you to learn about what the dynamics are, learn about how they work, learn about the risks that are associated with it, and then you can make an informed decision about what you want to invest in. What I will say is don't invest in any meme coins, right? If you take nothing else, don't invest. Well, I already said if you don't take nothing else, but add that to the don't take nothing else list. Meme coins are not. They're not a way to make money, right? They're like big Ponzi schemes at the end of the day, right? So just stay away from those. But Joseph, to your question around staking and those other dynamics, right? Peer-to-peer lending, right? That's all in this scope of like, hey, where do I think my investment risk is, and what's the investment risk that I'm willing to take on? And so if you think about taking on something that if you think that's, as you think about your strategy, just saying, hey, I'm willing to take on a little bit more risk, and I can understand that I may not get paid out or I may lose that money, but it's all part of my plan and my investment strategy. That's a fine approach for you individually, right? It just depends on what your approach is and what your strategy is, right? There's no necessarily right or wrong approach, right? It just depends on what works for you. And so then jumping into the long-term investments, I know we're on this slide a little long. These are going to be the things that as you guys plan for retirement, right? These are going to be some of the tools that are available for you. So 401ks, IRAs, Roth IRAs, Social Security. Again, you may have access to pensions depending on where you work on. These are going to be investments that you guys think of that you can't necessarily access until you're in that 62 and a half or 59 and a half or 65, depending on which one it is, right? That particular time frame, right? So all of these types of investments typically invest in stocks, bonds, mutual funds. Some of them may invest in cryptocurrency, right? They invest in those particular options, but your ability to access them is going to be at the latter part of 59 and a half, right? That's going to be the phase of, as you guys think about your planning, when you can start to use and access that money. So you may say, hey, I want to retire at 40, right? Your plan for retiring at 40 is going to, and how you use these particular investments is going to look very different than someone who says, I want to retire at 65 or I'm going to retire at 59 and a half, right? Their approach to how you get there will look differently, but these have to be part of your plan because again, that responsibility is now shifted to you more than likely. And how you think about the investment is going to be more on your shoulders to make sure that you are in control and understanding what's going on there. So again, as you think about this compound interest, right, there's really three key factors that we talked about before, right? There's the investment amount, there's the time that you invest in the market, and there's the rate of return that you get. And so again, this is where we started, right? I've extended the time frame out here from 30 years to 40 years, right? But again, you can see, hey, if I did it for 40 years with the first example, I put in 108,000. Now my money has grown to 1.2 million. And so when you think about this average return, right? The average return is over the history of the market, right? The history of the S&P 500, and it's a long-term approach. And so if you guys think back, right, over the past 25 years, the S&P 500, even if you're not super familiar, hasn't gone up every year, right? During the COVID time period, it was at the end of the year it was up, but during those first few months of COVID, the market was down substantially. During the 2008 financial crisis, the market was down substantially for a couple of years. And so the market will go up and down. It will fluctuate over time, right? But if you look at the average over the historical long period, right, it's still been on the upward slope of 10% a year. So and what the idea and the concept that I'm trying to convey to you guys is that you guys aren't necessarily trying to time the market. You're not trying to jump in when it's down. You're not trying to get out when it's high. You're not trying to sell your money when you think the market is going to crash. You're just consistent. You're consistent 225. If it's up, 225. If it's down, the number can be whatever your number is. It's 225. We have a consistent approach over time. So yes, as you look at the market this year, the market is down substantially. Well, it's down. It's not down substantially. It's down. And so that may be a place where you say, hey, I have some angst, some panic about it. But again, our approach is long term. We're not worried about the up and down. We're just consistent over time because we know over time it's going to have this 10% slope. And so when you think about, again, those three key points, what happens if I increase my investment amount to $600? Same return, started with 0, but now I put it in $600 a month. You can see, right, over time now, over that 40 years, I put in 288,000 up for that 100,000, but now my money is going to 3.2 million, right? Again, this is the power of compound interest that we're trying to take advantage of. And instead of getting 40 years to get to $1 million, now I can get to $1 million at 30 years. Well, you say, Derrick, what happens if my return changes, right? Instead of making 10% return that I was over time, getting to that 1.2 million, now I'm making an 8% return. Well, that's a substantial hit. Right now I go from 1.2 million expected to 700,000 expected. But if I was making a 12% return, if I was in some assets that gave me a slightly higher return, that would get me to 2 million. So all these factors matter. And so you would say, hey, Derrick, I know you're saying you're saying, hey, if I was in the S&P 500, I can get that 10%. But the other responsibility, again, as you guys move into your careers, as you guys start to invest on your own, you have to make sure that you're understanding the things that you're invested in. So like at my company, they do 3% automatic investments for you, right? And they put those into a particular fund. Well, if I'm not necessarily watching my funds, I may not be getting to that 10% return that I'm targeting. If I'm saying, hey, I need to get to 1.2 million in 40 years, if I'm not looking at my investments, I may not be getting to that particular rate of return that I need to, or I may not be putting in enough money. That 3% may not be enough. So again, as you guys think about this shift in responsibility, it's going to be much more important for you guys to understand what your investments are that are out there, understand like how your company's 401k works, understand how their investments works, because it's going to be more your control to make those decisions long term. Okay, so as you guys think about reaching those financial goals and some of those ideas that we talked about, let's have a couple more slides. One thing I would say is determine your target, right? I put a retirement target, but this could be any target. It could be the target for purchasing your first home. It could be the target for, planning for your first kid, right? It can be whatever life event that you have coming up. Retirement could be just as good an option, but what's the time frame that you want to have? What's the lifestyle that you're going to have? How do I determine how much money I'm going to need for that particular action? The second thing is going to be adopting that framework, right? I like to use the 50, 30, 20, but if you were saving 30%, maybe you retire in five years sooner. If you were saving 40%, maybe it's 10 years sooner. You're saving 50%, maybe you can retire like Maxwell at 40, right? That could be a goal, right? It can all be part of your strategy. And the third thing I would say is reflect and evolve, right? Your plans are not going to be static, right? You may have an approach and a view, Maxwell may have an approach and a view today that he wants to retire at 40. And let's say, at 30 or 35 or 28, he gets married. Well, maybe that plan changes. Maybe it's like, no, now I can't retire at 40. Maybe I can retire at 45, but then he has a kid at 35. Well, I guarantee you, you're probably not going to be retired at 45 then, right? So that plan changes as you go through your life and you evolve and your life's evolve. You have to kind of go through this cyclical thing, right? That you're going to say, hey, what's my plan today? What's my target today? What's the plan that I'm going to use to accomplish that? I'm going to implement that plan. And as I'm approaching it, as life changing, I'm evolving that circle, right? And as I'm hitting these new life milestones and I'm hitting these different challenges, right, I'm going to adjust because it's not just positive things. It can be negative things, right? There are disasters. There are things that happen that can take you off your plan, but you have to consistently just re-evolve and evaluate. That's, I said, if you guys think about my family, we have a yearly evaluation. What are the things that that are important to us this year? What are the new things that we want to do? Are we on target for the goals that we set last year? It's a consistent evaluation. It has to become part of the things that you're doing on a consistent basis. And so this last slide, right? This is a general framework, and we'll share these slides with you guys as well. But you guys are going to be in this 30+ years to retire more than likely. And so what I would encourage you guys to do is to start to build that strong foundation. Start to think about investing in your 401k once you guys start working, or investing in the IRA when you start working. Start building out that 50-30-20 framework, living with the plan, exercising and tracking where your spending is going, and be comfortable with kind of this concept of delayed gratification, right? That you don't need everything today, right? Some of these things can wait, that you can sacrifice a little bit today for the flexibility and the freedom that you guys want in the future. And then, again, I'll share these slides with you. I know we only have 5 minutes. I'm gonna leave some space for questions, but things will change over time, right? And again, just be open and willing to adjust that plan and rethink that plan as you guys go forward. So look, I know we're up on time, right? I'm happy to stay on after this, after 1 o'clock, but I do want to make sure for people who may have to leave that you get this slide. So if you scan this slide, this will take you to the next section of the modules that you have to do to kind of complete that task.
Yeah, awesome. Oh, first and foremost, thank you to Derrick for this amazing presentation. Can we just say thank you in the chat for all the tips and lessons learned financially? Thank you. Thank you. Thank you, Synchrony, again, for being a partner and providing, information like this to our scholars. We truly, truly appreciate it. Just to reiterate the modules, again, first 50 to complete will earn that $100. You can complete them with your phone or on your computer. We highly encourage you to complete it in one sitting. It's about 10 lessons. It won't take you too long. Shouldn't take you more than an hour to complete. So we really, really want you guys to get that done. Thank you, scholars. If you have to hop off, we completely understand. Thank you for sticking with us for this hour on a Friday. And hope you have a great weekend. Take care of yourselves. But yeah, we will stay on in case you all have additional questions for Derrick. Otherwise, thank you guys for attending the session.